All right, it's late March, and we're going to talk about what the first quarter of 2023 has handed us and what we're going to see in the future right after this. Hey there, my name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, interest rates. Today, we're going to talk about Q1 of 2023, looking back, comparing it to 2022, and then projecting what we're going to see in the future. So as we get started, let's talk about rates first. That's typically where I start all of these videos, putting out weekly videos on the channel, by the way. So if you like the content, if you like it so far, I'd be forever grateful. Click that like button, click that subscribe, and then click that bell icon to be notified as I'm putting out weekly videos on the channel. Now, let's talk about those rates. So January 1st, according to Freddie Mac, and I'll put that link below, we started, let me find my notes here behind me, we started the year at 6.48. Today, kind of ending Q1 of 2023, we're at 6.32. So we have seen rates decline slightly over this 90-day period. We were absolutely trending at the beginning of the quarter up, that we were going to go touch those highs that we saw in October and November of last year. That was 7.08 according to Freddie Mac. But we were looking, we were going to trend that way. And then guess what? We had the banking crisis. We've still got that kind of external pressure as well. We've got more news in the war of Ukraine. We've got a lot of step up in that stuff. The Fed has only raised their Fed funds rate by 0.25%. So that was a little bit changed as they were raising it by 0.5% before. We've got more threat of recession. We've got continued inflation. So these are all external threats. Now, all of those items that I just mentioned, I'm going to bring up here again in my projections of why I think interest rates are going to continue down this trend a little bit lower going into the second quarter. But to end this, in terms of where rates are at, what we've seen is we were slowly going up that roller coaster, right? Going up that hill, clickety-clack, and then all of a sudden, a lot of the banking crisis and a lot of that time in the beginning of March started to push us over that little hill, and now we've started to trend back down, and I believe that trend, that little ride down, is going to be a little bit longer and take us into summer. So I next want to talk about days on market. So this is one of those, I'm in the Chicagoland area, northern suburbs. So I'm cherry picking some data numbers around kind of these different areas that are unique to me, not using the United States necessarily, but just using local data for people that would be in my area. So days on market have absolutely picked up, 10 to 20 days added on just in this first quarter. Not surprising, given this is our winter, right? This is our kind of toughest couple of months that the days on market have increased. So we saw 10 to 20 days on average in these suburbs and the city take us to roughly 80 days on market being the average. So, but there are definitely some outliers. We saw suburbs of like Evanston and Wilmette perform exceptionally well. I can't say enough in terms of prices, like in Wilmette, and the average kind of median home sale price over these last 90 days on how hot that market is in compared to a stable market maybe in the city of Chicago, where we saw prices, plus or minus 1%. I'm making this video here at the end of the quarter, but the new data won't be out for a few weeks. So maybe I'll come back around and touch this back up here in a few weeks' time with a new video. But for now, we saw the city of Chicago very kind of flat. So with that said, prices pretty darn stable Chicagoland area, but you've got a few of those outliers as well. What we're seeing from Q1 going into Q2 is that now we're starting to see what looks like a lot like 2022. We're starting to see multiple offers. We're starting to see properties going over asking price at times. In Chicago, in the first quarter, we saw roughly 2 offers per property, before it went under contract. In some of these suburbs, we're seeing an average of 4. I know for a fact I've got clients looking, I'll bring Wilmette up again, looking in Wilmette. They've been beat out on a couple of properties that they've made offers on already pretty significantly by over $100,000. So now we're obviously talking about higher price points, but take that into your individual market when we talk about maybe like 10% over asking, 5% over asking. So again, we are seeing the home prices pretty stable and appreciating. And I'm going to now loop back to what I said at the beginning. Some of the reasons why I see these rates continue to stay lower is because of the banking crisis, the war, the inflation, recession. Those things are still out there. That is also my take on why housing prices will likely still stay stable, if not appreciating at a small amount, because these things are going to still keep those interest rates lower, hopefully bring in a little bit more buyers to the scenario. We still have super low inventory, so therefore we're going to continue to see low inventory, high demand, which is going to continue to keep prices stable and or up. If all of a sudden we have a ton of inventory come out and then super low demand, that's where we're going to start to see those housing prices decline. But I do not have a use case, at least in this municipality, in this area, that we're likely going to see that. So this is my Q1 market commentary. Let me know what questions you have. If you're thinking about buying a home, if you're an agent, if you just want some mortgage tips, real estate tips, click that subscribe button. I'd be forever grateful. Stay safe, and we'll see each other again very, very soon.